The story of Elias. Why saving money is making you poor. The cult of the cushion. Elias lived by a simple, unyielding mantra. Security is a number, and that number must always grow. Every paycheck saw a ritualistic transfer, a significant portion migrating instantly to the emergency fund. An account he checked daily, relishing the escalating, satisfying digit on the screen. He was the envy of his peers, the sensible one, the man with the massive cushion. He denied himself small pleasures, wore shoes until the soles flapped, and always packed his own lukewarm lunch, deeming every avoided expense a victory. This was discipline, he believed. This was the road to eventual wealth and peace. Yet, a faint, metallic scent of stagnation clung to his life, a subtle anxiety that the world was moving faster than his carefully hoarded cash. His account paid a paltry 0.5% annual interest, a fact he cheerfully dismissed, reasoning that safety was the real dividend. The cushion grew heavy, a dead weight of non-performing assets, while the rest of the world hustled, built, and compounded. Elias saw the balance, the raw, beautiful number, but he failed to see the subtle, creeping theft happening outside the vault's virtual doors. He was a master saver, a champion accumulator, but tragically he was beginning to confuse possession with prosperity, the nominal total with the real, dwindling value of his financial life. His money was safe, yes, but in its safety, it had become lazy, almost petrified. The whispers of inflation. The first true fissure appeared when Elias decided, after a decade of austere saving, to purchase the small, charming apartment he'd always envisioned. He had meticulously calculated the required some 10 years prior, factoring in conservative growth. When he pulled up the current market listings, the prices were jarring, a cruel, bewildering 20% higher than his projected maximum. He felt a sickening lurch of betrayal. The price of granite countertops and recessed lighting had somehow conspired against his diligence. Where had his caution gone wrong, he wondered, wiping a cold sweat from his brow. His cushion was bigger, but the goal was further away. He realized his purchasing power had been silently mutilated by a force he hadn't respected: inflation. That abstract 2 or 3% annual creep, dismissed as negligible on a monthly scale, had cumulatively devoured his decade of sacrifice. The comfortable number in his bank account, once a beacon of future ownership, now seemed like a treadmill beneath him, perpetually requiring him to run just to stay in the same place. The real value of every dollar he had painstakingly locked away at the start of the decade was now worth significantly less. The security he cherished was nothing more than a slow-motion form of financial entropy, a hidden tax on the cautious. The entrepreneur's shadow. Elias often found himself observing his former college roommate, Leo, with a mixture of scorn and envy. Leo was always in motion, launching eccentric businesses, a specialty coffee cart, a niche software subscription, a rental property managed entirely through an app. He was perpetually broke on paper, always reinvesting, always chasing a new, riskier venture. Leo's bank balance, Elias noted with satisfaction, was pitifully small, a constant high-wire act of liquidity. Yet, Leo had just purchased that charming apartment Elias wanted, and was already eyeing a second property, speaking casually of equity and cash flow. Elias saw Leo's low bank balance and judged him poor. Leo saw Elias's high bank balance and judged him idle. Leo explained that holding cash long-term was like storing ice cream in the sun. It looked substantial, but it was melting rapidly. Elias countered with the virtue of safety, the guaranteed principle. Leo simply smiled, pointing out that safety had a hidden cost: missed opportunity. This wasn't about gambling, Leo insisted. It was about putting capital to work, forcing the money to fight inflation and compound. The real danger wasn't losing 20%, it was losing the chance to gain 200%. Leo's equity was a growing tree. Elias's cash was a preserved seed. The coffee shop revelation. Frustrated and seeking answers, Elias found himself at Leo's specialty coffee cart, nursing a suspiciously expensive latte. He struck up a conversation with an older gentleman sitting nearby, a retired finance professor named Dr. Alastair, who was sketching complex flow charts on a napkin. Elias tentatively shared his dilemma: the stagnant savings, the rising home prices, The paradox of saving diligently yet feeling poorer. Dr. Alastair paused, tapping a thick fountain pen against the napkin, and then drew 2 lines, one flat and one steadily rising. You, Elias, are on the flat line, Dr. Alastair stated gently. You've achieved nominal success. Your bank statement says you have more dollars. But real success means outpacing the rising line, the cost of living. Your dollars are not working, they are merely existing. Wealth is not a stack of cash. It is the power of your assets to generate more income than the rate of inflation. Your savings are a liability in disguise, an enormous drag of non-productivity. He further explained that hoarding cash was a guaranteed way to participate only in the losses of the economy, never the gains. The bank uses your money to lend and invest, keeping the profits, while giving you almost nothing. The math of loss. Dr. Alastair's words had landed with the weight of a heavy ledger. Elias went home and ran the numbers, not on his future aspirations, but on his past losses. He calculated his average annual savings rate and compared it to the 10-year cumulative inflation and the average stock market return over the same period. The results were stark and sickening. Had he invested his savings in a basic, diversified index fund, even accounting for a few rough years, his total capital would have been more than double what it was now. The difference wasn't just a potential gain, it was a definite loss, quantified by the apartment he couldn't afford. He realized the fear of losing money had forced him into a position where he was guaranteed to lose value. His emotional safety net had become a financial anchor, dragging him down. He printed a graph showing the steady, upward curve of the market and the near flat line of his savings, a visual representation of the opportunity cost. It felt like 10 years of diligent work had been thrown into a slow-burning furnace. The irony was devastating. His discipline in saving was directly responsible for his impending financial defeat. The safety he craved had become the most dangerous path of all, a slow decline disguised as prudence. The first step of risk. The mental shift was the hardest part. The ingrained habit of protecting the principal at all costs fought violently against the new understanding that he must expose his capital to growth. Elias started small, almost secretively, opening an investment account with the trepidation of a tightrope walker. He liquidated just 5% of his sacred cushion and placed it into a broadly diversified, low-cost index fund, a move Dr. Alastair had recommended as the antithesis of gambling. The moment the trade executed, a jolt of pure panic shot through him, a feeling that he had thrown money into an abyss. He couldn't sleep that night. He checked the value every hour for the first week, watching it fluctuate by tiny amounts, up by $40, down by $52, experiencing a roller coaster of minor elation and major dread. He had to physically hide his phone to prevent constant checking, forcing himself to focus on the long-term rationale. Leo had advised him that volatility was the price of admission for real growth. He had to normalize the idea that his money wasn't a static number, but a living, breathing entity that fluctuated. Slowly, Elias began to acclimatize, reminding himself that his investment was a tiny sailboat caught in a large, powerful ocean current, not a ship sinking in a tempest. The portfolio blooms. 6 months blurred into 12, and Elias stopped checking the daily movements. He continued his monthly saving ritual, but the funds no longer migrated to the lazy savings account. They were immediately routed to the investment portfolio. The initial 5% was now 15%, and the rest of the cushion remained as a solid, 6-month emergency buffer. One afternoon, while reviewing his annual statements, he saw it, a small, yet undeniable green number that represented growth far exceeding the tiny interest earned by his bank account, even after factoring in the minor fees. It was a revelation. The concept of compounding had moved from theoretical math to tangible reality. His initial investment wasn't just growing, the growth itself was generating returns. His money was, as Leo had put it, finally working for him, not against him. He felt an intense wave of liberation. The fear hadn't vanished entirely, but it had been replaced by a quiet confidence and a sense of participation in the economy. Elias was no longer just the consumer of rising prices. He was now a fractional owner of the companies driving those prices, allowing him to participate in their prosperity. He realized wealth was less about hoarding and more about strategic ownership. Financial freedom redefined. Elias had fundamentally redefined what it meant to be poor. Being poor wasn't just about lacking money, it was about lacking financial understanding and allowing fear to dictate major financial decisions. The man who hoarded a vast pile of depreciating currency, paralyzed by risk aversion, was poorer than the one with less cash but a growing equity stake. His journey wasn't about getting rich overnight. It was about shifting from a scarcity mindset to an abundance mindset, understanding that capital is a tool meant for production, not a trophy meant for display. He eventually bought a home, not the exact apartment he'd initially coveted, but a better, larger one that his growing assets could comfortably manage. His cushion remained, but it was now supplemented by a constantly compounding portfolio, a real engine of growth. He was still disciplined, but his discipline was now directed towards smart allocation, not pointless accumulation. The true definition of financial freedom, he concluded, wasn't having enough cash to survive a disaster, but having enough productive assets that you could afford to take a calculated, meaningful risk. He had finally escaped the poverty of prudence.